Hey, good morning, good afternoon, and possibly good evening. Welcome to today's webinar, The Importance of Alternative Investments in 2024 and Beyond, presented by Kaplan. My name is Brian Stype. I'm a segment sales director at Kaplan, and I'll be the host for our event. Today's webinar will explore what alternatives are and how best to prepare your firm to handle the generational wealth transfer and investment preferences of a new breed of younger and more aggressive investors. This is the second of a series of Kaplan's thought leadership webinars designed to educate and demystify current topics impacting organizations in the investment industry. Our first, held in February, talked about hiring trends and how an evolving hiring landscape has changed the required skills for HR professionals. Future webinars in this series include diversity in financial services, to be held in September, and scheduled for November, succession planning. A few housekeeping notes before we begin. We are recording today's event, and we'll share a copy with you in a few days. Second, attendee participation is highly encouraged. Aaron and I have a bunch of content to cover, but answering your questions on alternative investing is appreciated, and you can use the Q&A function in Zoom to submit questions. We will do our best to answer them as they come in, or wait until the end, depending on how the conversation is going. If you have additional questions about this topic or Kaplan in general, email us at clientaccountmanagement@kaplan.com. And now, before I introduce our featured speaker, a quick Kaplan commercial. Kaplan is a global leader in financial certification training and has a wide variety of learning options available to both individuals, university, and corporate clients. We provide industry-leading education in the areas of wealth management, insurance, securities, asset management, and most pertinent to today's conversation, alternative investments. Please visit kaplanfinancial.com/businesses to learn more about how Kaplan can help you and your training needs. And now today's guest speaker, Mr. Aaron Filbeck, CAIA, CFA, CFP, CIPM, NFDP. Aaron oversees, big deep breath for me. Aaron oversees UniFi by CAIA, a learning platform dedicated to education and educating the private wealth management industry on alternative investments. He was previously responsible for leading and implementing CAIA Association's content agenda, thought leadership initiatives, and content development for the CAIA Charter program. Aaron is a frequent speaker and writer on various topics of alternative investments, and his work has been published in CAIA's educational programs, numerous academic journals, books, and industry publications. His industry experience lies in private wealth management, where he oversaw asset allocation, portfolio construction, and manager research efforts for high net worth individuals and institutional retirement plans. Aaron, welcome to the webinar, and thank you so much for participating. How are you today?
Good. Thanks, Brian. I'm excited to be here, excited to talk about alternatives.
That's great. We are honored to have you, and I can't think of a better person to speak on this topic. So just to start, I'd like to set a good framework for the discussion. So can you provide the audience with an explanation of what alternative investments are and what CAIA is in general?
Yeah, sure. So I'll start with CAIA. So CAIA, CAIA stands for the Chartered Alternative Investment Analyst Association. We're a professional body and a professional association focused on providing greater transparency and education in the world of alternative investments. And we do this through a couple of different ways as an association. One being our formal education program. So the CAIA designation, the UniFi by CAIA learning platform, and those being kind of the two formal pathways from a formal education perspective. Second is we do a lot of thought leadership and content in the industry, partnering with asset managers, with wealth managers, speaking at conferences, webinars, long form white papers, and so on, that constantly engaging with the industry to both inform our members, but also inform the broader industry about this very fast growing and evolving space. And then third being, we do a little bit of advocacy as well. So meeting with regulators around the world, all with the mission of ensuring that the capital markets are functioning as they should be, but also putting the investors' interests first and protecting the end investor, particularly as we continue to grow in this space. So that's a little bit about CAIA. In terms of what are alternatives, so this is the ultimate question because there's a couple of ways that you can define this world. one of the easiest ways to do this is just to say, well, alts are pretty much everything that's not traditional, which is very broad and not very helpful in terms of creating a definition around this space. The way that we tend to look at the world of alternatives is we're focusing on what most of the large institutional investors are allocating to in their portfolios. That comes down to four kind of core pillars of different alternatives. There's a couple outside of these four pillars, which you can talk about, but the four being private equity and all of the different flavors of private equity across the equity life cycle. So venture capital, growth equity, and buyouts. Private credit being the second pillar. So across the capital structure, across different styles of private credit, any of these non-traded debt instruments that fall into the private credit space. Third being real assets, and that encompasses everything from real estate to infrastructure to commodities, natural resources, also things like artwork and other kind of real tangible assets. And then fourth and finally are hedge funds and all of the different styles of hedge funds. Now you can throw a couple of other things into this mix. Digital assets and cryptocurrency is small but growing and somewhat volatile. So that measurement on a day-to-day basis may change, but crypto, and then there's collectibles, artwork I mentioned before. Some of these are kind of smaller, more esoteric areas of the alt space, but typically institutions are allocating to those first four components at the moment.
Okay, great. Thank you for that. And so can you share common misconceptions about alternative investments? I've done a lot of research on the side about this, but I'd love to hear from you about what are things that you have to overcome when talking about alternatives, or what are some preconceived notions that people have that are incorrect?
Yeah, so there's a couple ways I think that you can answer this. One is the idea that alternatives are all one thing. That tends to be one of the biggest common misconceptions. And if you look at this industry today versus just 20 years ago, so today alternatives, by the way that we measure it, those four pillars that I mentioned, represent about 22 trillion US dollars in assets under management, which is roughly about 15% of the total industry when you include long only traditional markets. That makeup of 22 trillion is really diverse and encompasses those four pillars, private equity being the largest, hedge funds and real assets being kind of second largest. Private credit is smaller but growing relatively quickly. But if you look 20 years ago, that alternatives umbrella was mostly hedge funds. And so I think there's a common misconception that, alternatives are just kind of one thing, when in reality, you've got very different underlying strategies and underlying risk and return profiles and drivers of returns. So that's probably the biggest misconception. The other is around just some of the characteristics of alternatives. I think there tends to be, because it's maybe not as well defined, maybe not as well known, there's this conception that alts are just a really aggressive, kind of high octane part of your portfolio, when the reality, as I mentioned before, these strategies look very different. Private credit as an asset class has a much more conservative risk return profile than private equity. Hedge funds have more flexible risk return profiles. And so there's a lot of different roles that alts can play in the portfolio, whether it's providing additional growth and playing offense in a portfolio, like a private equity portfolio, providing additional income, like you might find in private credit, or even areas of real assets like real estate. Downside protection might be a component of some of these strategies. You might find that in areas like infrastructure, or even in the hedge fund complex, depending on the strategy. So it's a very diverse, maybe as the bottom line, it's a very diverse industry.
Sorry about that. I just logged off for some reason. Can you
No
hear me?
worries. Yeah, you're coming through.
You thought you were doing the rest of the webinar solo, didn't you?
I was ready to go. I was ready to go.
Thank you for that explanation, and that all makes sense. And I apologize for that technical snafu we just had. You touched on this a little bit, but I'd like you to expand. Just how have alternatives evolved, right? What's the evolution just compared to a few years ago, and also where do you see this area going?
Yeah, so I mean, there's the growth evolution. So 22 trillion today. 20 years ago, that was roughly 6 trillion. So we've nearly quadrupled in about a 25 year period in assets under management. So that is certainly one massive evolution, and that growth has come from more areas outside of just the hedge fund space. So private equity was it was relatively small as a proportion of that 6 trillion 20 years ago. Today, it's the largest component. So of the 22 trillion, private equity is roughly 10 to 11, so almost half of the overall alternatives complex. So the makeup has certainly evolved, and these industries have become much more mature by just a proxy of growth. I think some of the reasons for that growth and the reasons for the evolution have been, particularly in private equity, we've seen the role of private markets relative to public markets change, particularly since the tech bubble, but even more accelerated since the global financial crisis, where companies are staying private for longer. They're either not going public at all, or they're taking much longer to actually go public into the public markets. And so there's a lot more funding rounds, in particular, like in the venture capital space. It used to be you might get one or two funding rounds, and then you go public and you raise a bunch of capital from the public markets. Today, most of the value creation is actually happening in the private markets. You have a similar story with private credit, so particularly post GFC, when a lot of the banks stepped back from lending to small and medium-sized businesses. Those companies still needed funding. They still needed financing to run their operations. And so the private markets really stepped in to provide that source of capital for these businesses. And that trend has continued pretty aggressively since the global financial crisis. And so private credit is really, particularly here in the United States, it's a little bit different over in Europe and Asia, but in the US, the majority of financing for these companies comes from the private capital markets. So I think that's just an interesting kind of macro trend that we've seen, and I think illustrates a reason why alternatives may make sense in a portfolio, because you're accessing a completely different area of the economy of the capital markets. In terms of other evolutions, one in particular that we've noticed in the past 5 to 10 years is alternatives used to be exclusively for institutional investors. So endowments, foundations, sovereign wealth funds, pensions were the heavy allocators to these strategies, endowments probably being the most aggressive. And we've seen, family offices have certainly stepped into this space in a very aggressive way. But even going down market to high net worth individuals, the mass affluent individual investors who historically have not had access to a lot of these strategies now have access. The asset management community has kind of opened up different vehicles and different ways of accessing alternatives. And so the private wealth kind of wave and interest in this space has continued to grow, quite dramatically. So I'll stop there. I think those two trends are probably really big ones. There's other ones that we can talk about, but I'll pause there.
Yeah, I would like to pick at that last thread you mentioned. I read an article or a survey or report. It said young investors are 3 times more likely to invest in alternatives than older generations. All right. Now that depends how you're defining the young versus the old generation.
Yeah.
But could you kind of just elaborate on that? What are you seeing in that area specifically? I know you mentioned family offices and high net worth, but are there other kind of just that younger generation that are more, and I don't know if that's a crypto attraction from a few years ago or what, but if you could just talk about that, that would be really helpful.
Yeah, so I think there's a couple things. I mean, one is, the crypto craze that we saw, particularly during COVID, was I think maybe part of that level of interest. And um, I think there's a couple of reasons for that. One, um, when you look at the public markets and the capital markets in the public markets in general, um, I think there's almost a distrust to some degree in the younger generations. They kind of, if you're a millennial like I am, or even Gen Z, you've gone through a couple of mini crises over the course of the past 10 to 15 years. And so, you look at the stock market and it looks risky, it looks volatile. And so there's probably an appetite to kind of move into other things. And crypto was exciting. It was going up during the COVID-19 global pandemic. And so I think some of those things might have driven an attraction to it. But outside of crypto, there's a lot of other areas of the quote unquote alts market that I think have been attractive to the younger generations. We've seen some providers come out and provide access to affinity type of assets. So whether it's artwork or collectibles, there are platforms now that allow you to kind of trade fractionalized shares of things that people are already familiar with. Like if I want to trade a fraction of an action figure or a classic car or I don't know, a Pokemon card or anything along those, like I'm familiar with those as assets. I may have had them when I was younger, and so there's that kind of tangibility that it brings to the portfolio. On the kind of core four pillars of alt, so again, private equity, credit, real assets, and hedge funds. I think there's a lot of interest in the younger generation to access companies that they're familiar with. So whether it's Uber or it's Spotify, a lot of these companies were private for a very long time before they ultimately went public, and so being able to access these different companies that you may use on a day-to-day basis, I think is attractive for a lot of people. People like to own what they know, and you saw this with maybe the Gen X and the Boomer generation with owning individual stocks and saying, "Well, I own IBM, I own Coca-Cola." Today, a lot of the companies that we use in our day-to-day lives are usually private. If they're not public already, a lot of them are private.
That is helpful. Yeah, and again, I don't want to get too stat heavy, but I do have some interesting numbers here. And one more I want to share with you is, Mercer published a report last year and said that 85% of the financial advisors surveyed are expected to increase allocations to one or more alternative asset classes within the next year. So is that in response to the interest from the market? Maybe that's an obvious question, but I'll pose it.
Yeah, so I think and timing is a little bit of everything when it comes to surveys. I think in particular, 2022. So I'm sure the survey was performed maybe in 2023, I think you said, but 2022 was a really tough market for traditional investors, and we saw one of the worst drawdowns in the 60-40 portfolio. So 60% public equities, 40% public bonds. That 60-40 portfolio, which has historically been kind of your ballast, moderately aggressive portfolio. The idea of putting those two assets together is that stocks and bonds tend to be lowly correlated to one another. Well, in 2022, we saw one of the fastest and most aggressive rate hikes in history here in the States. And inflation, which was at a 40-year record high, which had negative impacts on both public stocks and public bonds. And so I think the 60-40 drawdown was one of the worst, and it was decades since we had seen a drawdown for a portfolio like that. And so I think that may have awakened a lot of investors to the benefits of diversifying your bets outside of just stocks and bonds as a portfolio. Now, it would have been great if diversification happened before something like 2022 happened, but I think there's a lot of reaction to the market that has driven a lot of interest. Alongside some of the more secular trends that I mentioned as well, with capital formation in the equity markets and the retrenchment of banks in the private markets or in the lending markets.
Okay. And now, we have a lot of, whether they're advisors themselves or planners on this call, or maybe they handle the training needs for an organization. I mean, can you talk about CAIA and how it could help you? This isn't like a very product specific webinar, but I think it's very timely. And
Sure.
I think a lot of the content is extremely helpful. So again, if you just want to take a few minutes to talk about how CAIA can help, what's the process for starting the exam? What's the makeup of a typical charter holder and candidate as well would be helpful.
Yeah. So I mentioned the two formal educational programs that we offer at CAIA. So the first being our CAIA charter program, the formal designation that investment professionals tend to go through, and then this UniFi by CAIA learning platform that we've developed for the wealth management industry. And these are two distinct but related types of programs with, I think, very different profiles of the type of professional that might be appropriate if you're looking for training. So the CAIA designation is a formal credential. It's a designation program that provides you with a pretty deep and technical learning experience on the world of alternatives. So we're kind of putting you in the seat of the investment professional who is analyzing, managing, potentially allocating to managers that manage these alternative asset classes, with the idea that as you walk out of the CAIA program, you should have a very deep understanding of how these different asset classes and strategies work, but also how they fit into a diversified portfolio. So it's a two-level exam. Level one is focused on those asset classes and those pillars. So we introduce you to each of these in sections throughout the program, all the flavors of private equity, private credit, hedge funds, and real assets. Some other topics are in there as well, like ethics and foundations of the industry, some digital asset coverage. But by the time that you walk out of level one, you should have a very, very solid understanding of what these asset classes are, the risk return profiles associated with them, how to analyze them as an investment professional, and so on. At level two, we're much more focused on that portfolio construction and asset allocation perspective. So by the time you get to level two, you should have a solid understanding of the asset classes, both on the traditional and the alternative market. And now we're talking about things like due diligence and asset allocation and risk management, sustainability, much more kind of top-down portfolio construction topics, so that by the time you finish level two, you've kind of sat in that allocator's seat who's allocating across multiple asset classes and multiple strategies. It's a very time-intensive program, so hundreds of hours on both levels to self-study. There's an exam offered twice per year that you go and sit for at a testing center. So if you've gone through a CFP or a CFA or a CPA, it's a very similar kind of experience to what you've seen with those particular programs. On the UniFi front, so we're teaching the wealth management industry. So if you're a financial advisor, financial planner, if you're a wholesaler in business development, but also if you're a lawyer, you're an accountant, you're in the back office, you may not be kind of in the actual investment management side of the organization, but you need a solid foundation just to understand the language, how these things work, how to articulate it to a client if you're a client-facing professional, we've developed a series of courses that are geared towards that type of professional. So it tends to be much more of a corporate engagement, but you can go through this as an individual if you want. But those two pathways, if you think about your organization, CAIA is much more for the investment professional, the analyst, the portfolio manager, the CIO. And then the UniFi platform is much more for the client-facing professional. And so we tend to see organizations will utilize both depending on their needs and where their employees currently sit in that learning cycle. But those are the two kind of pathways that we offer as an organization. CAIA is much more for an individual. So, you go through that program and it's a choice that you make as an individual. And we tend to see a lot of corporate, companies, asset managers, wealth managers, companies that want to enroll large cohorts, and they'll put these people through in a cohort capacity.
Great, thank you for that. And one of the benefits, I think, or the perks for CAIA is it can be completed in 1 calendar year, right? So they can take level 1 in the spring and then level 2s in the fall, and they've wrapped that up. Now, obviously, they have to study and make sure they're competent in everything. But that is a huge change from CFP or CFA as well. So I think that's interesting. Now, are these global programs as well, or is it mainly US, North America?
Yeah, so we're a global organization. And these programs are global in nature. So we don't take kind of any kind of regional bias, particularly in the CAIA program, which is, we've got professionals all around the world who have gone through this program. And to your earlier question on who these people are, that might help inform the answer too. So we have 14,000 members around the world who have gone through the CAIA designation, and they sit across the entire industry. So we have professionals that sit at asset management firms, at GPs, at asset owner firms, academics, regulators. So it's a very broad and diverse, but all of these people somehow interact, manage, or analyze alternative investments. But it's regional as well. So we've got about 50 to 55% of our members here in the Americas, so primarily the US and Canada, some in Latin America. That's a growing area for us. 30% or so in Europe, in the broader Eurozone. And then the balance of that is in our Asia Pacific region as well. So pretty geographically diverse across 100 different countries. On the UniFi front, we tend to see most of our customers in the Americas. So I'd say 90% or so are from US and Canada. We've designed the programs to be pretty much globally applicable. There's some US specific content just given our customer base, but we found that translates well still over to other regions around the world. And we've had about 14,000 to 15,000 or so individuals go through any of the programs that you find on the UniFi platform.
Okay, great. And now prerequisites. So does someone have to have an investment background? Do you have to have a 4-year college degree? Do you have X number of years of experience? What are some of the prerequisites?
Yeah, so there's no prerequisite to sit for the exam on the CAIA front. So we have people with various backgrounds who sit through the designation program. Obviously, it's helpful if you've got a business or a finance or maybe even a quantitative background, but everything that you find in this program is contained within the program. So it's not like you're going to be learning things that are outside of the curriculum materials that you get. It's all kind of contained within it. So short answer is no. I mean, you don't have to have a background in finance to sit for this designation. It just will make it a little bit easier, I think, for you. But I know some very smart people who have not had a background in finance who have sat through and been successful. On the UniFi front, even more so, you really don't need a background. We're kind of walking you through the foundations of this space. So by the end of it, you should actually have a pretty decent background at a high level to understand this industry.
Great. Yeah, I only have a couple more questions here. Where can the attendees and people find out more information? So about UniFi, about what CAIA is doing, about what you're up to. I know you're constantly traveling, talking at different conferences and engaging with people. So where can they find more information?
Yeah, well, so our website is a great place to go. We've got a lot of information on there. So, our programs are available on the website. You can sign up there. You can create an account to stay engaged with us. And then we're pretty active on social media. So on LinkedIn, Twitter, and you can follow our corporate handles. You can follow me on both. But we love engaging with this industry. So feel free to connect with us.
Great, thank you. And if we can pull up the slides quickly. Here we go. So I mentioned this earlier, but the next webinar in this series is fostering DEI initiatives in the financial services workplace. That'll be on September 19th, as you can see. We'll be sending more information on this in the coming weeks, so be on the lookout for that. Teresa, I'm just answering your question in real time here. It's CAIA.org. So CAIA.org is where you can find more information on that. Oh, thanks, Aaron, for helping with that one. Next slide, please. All right, so more information about how Kaplan can help. And again, we have the CAIA website there at the bottom, kaplanfinancial.com/businesses to learn more about what we are doing. You can email us directly as well if you have any questions. We'll be following up via email after today's webinar with what we can do to help. So that concludes today's webinar. Special thanks again to our speaker, Aaron Filbeck. Aaron, thank you so much. It's great speaking with you. Appreciate the time. And a special shout out to Jack Russell, Julia Taylor, and Greg DeLuise working behind the scenes. So on behalf of Kaplan, we want to thank you for attending today's webinar, and we look forward to meeting your training and L&D needs in the future. Have a great rest of your day, everyone. Goodbye.
Thanks, Brian.